All right, so here is the full video of the 2-1 temporary interest rate buy down program. So this is a program that actually is eligible for fixed rate conventional FHA and VA loans. And what it really does is it allows the buyer to reduce their monthly mortgage payment in the first and second year of the mortgage that they're going to take out. So this is for a purchase loan. Advantages to buyers and to sellers. Buyers obviously will have a lower payment the first 2 years. And sellers, if your house has been sitting on the market for some time, this is a chance for you, instead of doing a price reduction, to basically give a seller credit instead, which will net you the same amount of money, but get more buyers through the door and try to get more offers on your property. So we're going to do some math and go through the different example of how this would look if this was the type of program that the buyer wanted to do. So again, it's called a 2-1 temporary interest rate buy down. And I'm going to assume a sales price in San Diego, California, San Diego County of $800,000. So if we took $800,000 times a 10% down payment, that would mean the buyer would come up with $80,000 down payment, plus of course closing costs, because they're not included in a purchase. That would give us a loan amount of $720,000. And again, $720,000 is considered a high balance loan. I like to give that in my examples because if your loan amount is at $647,200 or lower, it's not considered high balance, which is going to get you a better interest rate overall. And the reason is, when your loan amount goes over $647,200, Fannie Mae has what's called loan level price adjustments added to the interest rate. So I'd like to just give kind of that caveat to it, because in case interest rates are a little bit higher than what you're hearing, that would be one of the reasons for that. So with this program, we're really going to focus on what's the principal and interest payment is. So if you're buying owner occupied with 10% down, the seller can actually contribute up to 6% of the sales price to go towards this 2-1 interest rate buy down program. It could go towards discount points to buy down the rate. It could go towards closing costs. It just cannot exceed 6% of the sales price. In this example, if the sales price is $800,000, the maximum seller concession or seller credit would be $48,000. If we assume an interest rate of 6.5%, I actually pulled this pricing today, with a 780 credit score, a 45% debt ratio, with 10% down, an APR of about 6.8%. If our loan amount is at $720,000, your principal and interest payment would be about $4,551. Now, that's not including taxes or insurance or mortgage insurance. It's just principal and interest. Okay, that's important to know, because the way that this program works is the first year, the buyer actually pays an interest rate that is 2% lower than the rate that we lock them in at. So you come to me today as a buyer, you're in contract. I lock you in at current market, which is 6.5%. Your interest rate your first year will actually be 4.5%. So it's 2% lower. Okay. The principal and interest payment would drop down to $36.48, which is a little over $900 a month less that you would be paying as a buyer every single month for the first year of your mortgage. Now we have to take that number, multiply it by 12, because the seller contribution or the seller credit would need at least that $10,834.44, because that's what's covering the amount of payment savings that you as the buyer is getting the first year. Okay. Now don't forget about year two. So year two of the 2-1 buy down program, the rate would be 5.5%. And that's because the start rate was 6.5. You're going to go down 1% in year two, which is 5.5. The principal and interest payment would be $4,088, which is about $463 lower a month in payment over the whole second year of the mortgage. Multiply that by 12. That's the buyer saving about $5,556 in payment savings. Okay. So what we have to do is we have to add those two numbers together. You take the savings from the first year and the savings from the second year. So that's $16,391 that the buyer would save by having a lower interest rate with this particular program the first 2 years of the loan. Now that's a 2.05% seller contribution. And if you remember at the beginning, we said the seller can contribute in this circumstance up to 6%. So that's 4% left over if we wanted to try and negotiate for closing cost credit or even discount points to buy down the interest rate further. So what happens is at the closing, these proceeds are held back from the seller. We're going to put them into a separate account that's held. So every single month when the buyer makes their mortgage payment, we're going to take from that account and offset the difference of what the buyer should be paying at that higher rate. Okay. Now, again, not all mortgage lenders have this product because you have to keep the servicing of the loan in order to make this happen. Ideally, the goal would be year 1, year 2, even a little bit in year 3, because year 3, the payment and rate go back up to what it was locked at. Potentially interest rates could be lower. That could mean an opportunity to refinance and just get into an overall lower interest rate for another 30-year term. Okay. So what I want to do is a quick comparison about the 2-1 interest rate buy down using the 2% seller concession versus using the 2% seller concession to buy down today's rate. Okay. So basically you can use that 2%. Let's say the buyer, I don't want to do a 2-1 buy down. Like that's just not what I want. Instead, I would rather buy down the interest rate using the 2% credit from the seller. Okay. So if you did that today, your rate would drop to 5.625 from 6.5%. Now that's over the life of the loan. So for 30 years, you would have that fixed rate and payment. The principal and interest payment would be $4,045. So what I wanted to show people is even though your rate's higher that you're locking in on with 0 points, okay, if you take that versus the difference of you buying down the rate up front, it's about $406 per month that you would save if you bought down the rate up front with discount points and did not do the 2-1 buy down. $406 a month savings over 24 months equals $9,744 in payment savings. Okay. Versus $16,391 using the 2-1 buy down program. So pros and cons of each, right? It's whatever you're comfortable with. If you don't want to pay that 6.5% at the higher principal and interest payment starting year 3, then you may want to use the seller credit to buy down points and get an overall lower rate and payment for the life of the loan. It really depends on how long you're staying in the home. If you're potentially going to refinance. With 10% down, you're going to have monthly mortgage insurance. So generally with appreciation, the way that it's going, hopefully in 2 years, you're going to earn enough equity to even be at 80% loan to value. So when you refinance, you can remove that mortgage insurance as a benefit as well. So there's some different percentages based on loan program that I wanted to go over. Owner occupied purchase with a 5% down payment, the max seller credit is 3% of the sales price. With 10% down, it's 6%. If you're doing an FHA purchase, the credit is 6% of the sales price. And a VA purchase, it's 4% of the sales price. Now, if, we said, this is only 2% in our example, but we can go to 6%. So that other 4% that's left over, you can combine it with the 2-1 interest rate buy down with discount points. You could get a seller credit in addition for closing costs. So that's something that we just have to figure out with our agents and with the buyer and the seller and what we can negotiate to make the transaction work for everybody. What's ineligible on this particular product? No refinance loans, no adjustable rate mortgages, no renovation programs, no jumbo loans. And jumbo is like when it hits like $1 over that county loan limit. No USDA, no manufactured housing, and no investment properties. And both the buyer and the seller will sign a buy down agreement at closing. And that will just explain to everybody why the funds are being held, the account that it's going into, and that it will be used to pay the buyer's payment. So again, this is Tracie Schmidt with the Schmidt team at Supreme Lending. I hope that this product is something you think that your seller and your buyer could take advantage of. Real estate agents, if you have an example of a home sitting for a while, you can reach out to me, give me those parameters, and I could let you know, instead of reducing the price, what type of incentive maybe the seller could give in the form of a credit. Home buyers, this is great. I mean, if you didn't take advantage of the lower interest rates, even just a few months ago, this is a way for you to lock in at current market, which you would get anyway, right? And take advantage of 2% lower the first year and 1% lower the second year. So again, it's the Schmidt team at Supreme Lending. We make mortgages easy, and I really appreciate you watching this video, and let me know if you have any questions. Bye.